Steve, stick around. There's much more to delve into. And my next guest says the ECB cut is the right move, and the Fed better follow suit soon. He expects their first cut to come in July with about 3 more cuts, 75 basis points this year. Let's bring in Luke Tilley. He's chief economist at Wilmington Trust. Luke, it's great to have you here. Welcome.
Thanks for having me on, Kelly.
One of the debates going around, Luke, is that these things tend to come in bunches and come all at once. So whoever in the world starts cutting, and I think Canada tried to argue today, no, we might have cut, but, it's not to say that the U.S. is going to follow suit. But history suggests that typically these things all happen together and the Fed would be next. Is that your thought here?
I don't think there's any reason we should expect central banks to move together in principle. They should be responding to their own economies. Now, that said, there's a lot of global factors that lead inflation in different countries to move at the same time. I think the ECB is doing the right thing because their economy is a little bit on the weaker side. They don't have anything driving inflation higher, and they've got some risks there. So a step down here is right. On the Fed side, I think that they need to follow suit pretty soon, not because of anything that the ECB is doing, but inflation is running pretty low. Even if it's a stubbornly high on a month-over-month or a 3-month basis, the main thing about inflation right now, it is highly concentrated in shelter. If you look at the CPI ex shelter, it's been running roughly below the Fed's target for 12 months now. And we know that shelter is coming down. It lags those home prices, it lags rents, and we expect it to keep coming down. And that should become apparent pretty soon. So that's why we expect that first rate hike July 31st.
Fair enough. But, Steve, I might turn to the pair of ISMs that we got the last day or two and say that also summarizes the U.S. economy in this two-speed where manufacturing has been in recession for basically 2 years and the service sector is holding in there. And the service sector had price pressures that were not specific to real estate. So if I were the Fed looking at that report, I would think, well, that broader part of the economy seems to still be holding up pretty well.
All right. Well, I'll see your ISM services headline index, and I'll call you with the ISM services price index, which was actually down. Manufacturing is one of the sectors you would expect to be most affected by inflation. So you see that really contracting. I think we're moving into a second phase here, Kelly, of inflation declines, and that's this. Yeah, the first part was all supply side improvement or largely supply side improvement. Now I believe we're starting to see those industries and the broader economy start to be weighed down by these higher interest rate cuts. And I think that it may be time for the Fed to start thinking about cutting rates to ensure the soft landing. I will speak against myself for 1 second, Kelly. I didn't bring the chart on this, but I want to see if you remember what was one time when the ECB went quicker than the Fed.
Wasn't
remember
it
that time?
The recent one. Recently, haven't they been? No, well, wait. Are you talking about the hike? No. Not the financial crisis hike.
I shouldn't put you on the spot on national TV like this, but if you remember the great financial crisis,
yeah,
Trichet decided that the best thing to do to counter the great financial crisis was to raise rates, and that was not the smartest move. So you may want to be just a little wary of the ECB going a little too early with some things.
Well, in that case, I think they were just this kind of gets back to Luke's point that everyone in principle is running their own monetary policy. But in reality, we're a global economy and the U.S. is the lion's share. I'm sorry, but it is. So we're all probably going to head in the same direction. Luke, why do you think it is that other economies see less pricing pressure than we have? And Steve and I are splitting hairs here. The ISM prices paid, it fell a point. It was still at 58, right? So it's still way above the 50 level that indicates contraction. So there's this confusion about kind of what's happening with inflation and whether or not it's in the rearview mirror. But why do you think the U.S., should we expect it to be different? Why are other places experiencing less inflation already?
Well, U.S. had a little bit higher inflation because we had dramatically higher stimulus during the pandemic. It was about 25% of GDP when you added together the 3 rounds of stimulus, and that raised overall inflation a little higher than some other countries. But when it comes down to it here, we've seen the waning impacts of that. Consumer spending is up just 2.5–3% over the past year. That's pretty much the same growth rates you have in a normal economy, same we had in 2018, 2019. And really, businesses are dealing with the amount of spending, the amount of orders that they're getting just fine. There's no real pressure on prices on the demand side. And as Steve was saying, we got the supply side help. And the last thing is that we're starting to see a lot of weakness on the labor market side, not in the total non-farm payrolls, but there's a lot of permanent job loss. That's up about 330,000 people over the past year. It's almost never positive during expansions, and it's up. We've seen job openings cut by 33% from the peak. And we just see a lot of weakness on the labor market there. And I think that's going to play through the Fed's decision as well.
What about